All right, today we're going to crack open a really powerful framework for spotting those high probability bullish swing trades. This isn't about throwing darts at a board. It's a systematic, rule-based way to trade with the market's real long-term direction. Hey everyone, welcome to AI Explains ICT. In this video, we're diving deep into the core content from month 6, episode 4. And trust me, you are absolutely going to want to grab a notebook for this one because the details here are what make or break the strategy. So here's the game plan. We're going to kick things off by getting into the right mindset, thinking like an algorithm. Then we'll walk through how to line up our higher timeframes. After that, we'll cover 3 very specific trade scenarios. We'll see it all come to life with a real case study on silver, and we'll wrap up with how to execute and the key takeaways. Okay, first things first, we have to get our heads in the right space. To trade these setups effectively, you can't just see charts as a bunch of random lines going up and down. You have to start thinking algorithmically. You know, as ICT says, this is the foundation for everything. The idea is that the market isn't just some random, chaotic thing. It's basically an algorithm, and its job is to find liquidity and constantly rebalance price between 2 key states. And that leads us to the main tool for this way of thinking, the PD array matrix. It sounds complicated, but it's actually a beautifully simple concept. It just splits any trading range into 2 zones, a premium zone where things are expensive and a discount zone where things are cheap. And the golden rule here, super simple. We only look to buy when price is cheap, when it's in that discount zone. So check this out. This is what it looks like in practice. Anything above that middle line, the equilibrium, is your premium territory. Everything below it is the discount territory. Now, these arrays are just specific price levels where big institutions are likely to do business. We're talking about things like bullish order blocks or fair value gaps. For our purposes, as swing traders looking to go long, our entire world, our entire field of play, is only in that bottom green half, period. All right, so we've got the mindset down. Now, how do we actually find these trades? Well, it all begins with what we call a top-down approach. You start from a bird's eye view and slowly zoom in. And look, this sequence is absolutely critical. It's not optional. You always start with the monthly chart to see what the big long-term money is doing. Then you drop down to the weekly, and only then do you look at the daily. This process is what keeps you on the right side of the market's flow. So on every single one of these timeframes, monthly, weekly, daily, we're basically on a treasure hunt for the same 3 clues. First, we need to see displacement. That's a fancy word for a really strong, explosive move up that smashes through old highs. It screams institutional buying. Second, we need to see that this big move started from a clear discount array. It came from a cheap price. And third, as the price is climbing, we want to see that the down candles are acting like stepping stones, providing support and showing us that buyers are eager to jump in on any little dip. Okay, so once we've gone through that top-down analysis, the market's current state will fall into one of 3 buckets, one of 3 distinct scenarios. Think of these as your rules of engagement. They tell you exactly what to do and when to do it. Okay, scenario 1. This is the A+ home run setup. This is what we all hope to see. The monthly, the weekly, and the daily charts are all screaming bullish. They're all perfectly in sync. When you see this, the trend is your best friend. The wind is at your back. So what do? You can confidently look to buy at any daily or 4-hour discount level because you're expecting price to just continue expanding higher, and fast. All right, let's talk about scenario 2. In this situation, the big picture, your monthly and weekly charts, is still bullish, but the daily chart is taking a little breather. It's pulling back. So what do? We get a bit more picky. We only want to buy a daily discount arrays that are nested. What does nested mean? It just means a daily buy zone that's sitting right inside a bigger weekly buy zone. That overlap, that confluence, is a very high probability setup. And finally, we have scenario 3. Now this is the big one, the deepest kind of pullback. The monthly chart is still bullish, but both the weekly and the daily are correcting lower. To most people, this looks scary. It looks bearish. But to us, it's a signal that a massive, long-term buying opportunity might be setting up. The keyword here is patience. We do nothing until price finally trades all the way down into a major monthly discount level. Only then do we start hunting for entries on the daily or 4-hour. Okay, enough theory, right? Let's see how this actually works in the real world. We're going to walk through a textbook example using silver, and we'll follow our step-by-step process. So we're starting with the monthly chart for silver. Look at this massive move up right here.
It's a huge displacement that completely shattered the old market structure. That's our green light, our signal that the big institutions are bullish. And from that huge move, we can pinpoint a key monthly discount level, this last down candle before the explosion, right around $15.60. That level becomes our anchor point.
Okay, now let's drop down to the weekly. See what happens next. After that monster move on the monthly, price starts to correct, bleeding lower for months. But where does it finally stop? It comes right down into that monthly level we identified, that 1560 area. And here's the magic. That exact same area is also a weekly bullish order block. That's our nested scenario right there, a high probability confluence of support. So we've got our monthly and weekly charts telling us the same story at this key level. Now we drop to the daily and bam, look at that reaction. The second price touched that nested level, the selling just evaporated and a new, powerful rally took off. And you can see here, every little pullback, every down candle just became a new floor, a new support level, and another chance to get long. And this right here, this slide brings it all home. This is the aha moment. On the left is that weekly chart we were just looking at. On the right, it's the same chart, but now we've drawn our PD array matrix over the whole price swing. And look at that, it's so clear. The entire multi-month rally launched from deep, deep inside the discount zone, right off that nested level we found. It's a perfect picture of this entire framework in action. Okay, so we've nailed down how to find the right market context and how to pinpoint those key levels. Let's finish up by talking about the nitty-gritty of execution, and then we'll recap the main takeaways you need to remember. So where does the 4-hour chart fit in all this? Well, that's our sniper scope. It's for execution. Once price finally gets down to our key daily, weekly, or monthly level, we then zoom into the 4-hour chart to look for a very precise, very low-risk entry. But, and this is crucial, the 4-hour chart is just for timing our entry. It never determines our bias. Our direction always, always comes from those higher timeframes. All right, let's boil this all down to the core principles you absolutely have to remember. Number 1, always start top down, monthly, then weekly, then daily. No exceptions. 2, figure out which of those 3 market scenarios you're in. 3, frame every single idea within the PW array matrix. And 4, only buy at a discount. And finally, the most important one, be patient. This is swing trading, not scalping. These setups are rule-based and they can take days or even weeks to materialize. You have to let the price come to you. And that really brings us to the one question you have to ask yourself every single time you open a chart. Are you a patient predator, waiting for price to wander into your predefined high-probability trap, or are you chasing it after it out of FOMO? This whole framework is designed to make you the former. If you found this video helpful in breaking down ICT's concepts, do us a favor and hit that like button and subscribe to the channel. It really helps a lot. And of course, if you have any questions at all, just drop them in the comments section below, and a real human will get back to you. Until next time, be patient and safe trading.